Good afternoon, everybody, and welcome to NEPC's quarterly market outlook. Clearly, a lot to cover after the last few weeks, let alone the last few months since we've last met. I'm Philip Nelson, joined by my colleague Jennifer Appel. We're going to spend a couple minutes today going through, what we've seen in the markets the last few weeks. Maybe a little bit of a look back of how we've gotten here, how we got here. And then we'll take some time just to kind of address what are some key questions for folks that we've had amongst ourselves, that we've heard from clients, we've heard from other investors. Try to address that as much detail as we can. And then also, if you do have any questions, please enter them in the question box, and we'll look to address those at the end. Quick hit on just logistics. This will be recorded, and slides will be available on our website. Hopefully later today or early tomorrow morning, if you want to take another look. So with that, why don't we get going and we'll get right into it. As I said, when we kind of look at the last couple of weeks, clearly a lot's happened, a lot going on. We don't need to go kind of blow by blow of all the details in terms of tariff policies that have come through, kind of updates on kind of economic data that's flowing through. We're going to take a little bit of a look back, and you can see maybe some breadcrumbs or seeds of some market weakness that already had been present prior to President Trump's announcement on April 2nd regarding the reciprocal tariffs. So a long time machine back, let's go back to August 2024. We had a big spike in VIX, seemingly out of nowhere, where VIX shot above 50, got close to 60, and I think it surprised a lot of folks. And as there's still not a great answer as to what that was, but likely there was some amount of deleveraging that occurred, some combination in credit and equity space that caused that deleveraging, and VIX shot up very quickly. As we look back now, something we talked about, last summer of, okay, maybe there's a little underlying weakness in the markets. Let's not try to be overly aggressive. Let's be closer to our targets, make sure our duration is where we want it to be. Let's not be reaching for credit. These are some of the things we had conversations back last summer, but also maybe as a signal, underlying market foundations were a little weaker than maybe a lot of folks thought. And coming into November and the election, and the preceding several months, there was a big bullish optimistic trade that had built in, looking for equity markets to have a more deregulatory push, more M&A, really a kind of almost American exceptionalism trade to continue to flow through markets. And we saw into January kind of another blip that popped up. DeepSeek announced their AI model, which, as they announced it, was much cheaper to generate similar results, as they've said. NVIDIA sharply sold off, and a lot of other kind of AI-related names had a big sell-off that day, and really started to break down, some of the momentum and strength we've seen in AI, let's call it, over the last couple of years. So again, another signal of maybe there's a little more underlying weakness when you have these big drops in a single day. Flowing through to, over the course of this last quarter, S&P hit its high in February 19th. Later in the month, later in March, bit of surprise. And this is an important one to mention, a little more tangential, because we're going to spend a lot of time talking about it today, but still an event that's really big otherwise, is, Germany really shifted their fiscal spending policies, releasing the debt brake, allowing them to build out the balance sheet, have greater spending, defense spending, infrastructure spending. It's a dramatic shift in terms of Europe, and potentially what you could be seeing in terms of, European investment, both in critical infrastructure, defense, and also just pushing kind of higher growth rates in Europe, which we haven't seen, frankly, in maybe 20 years. And then we get into April with the tariff announcements, where VIX shot up quite quickly. We saw some big drawdowns, and then we've proceeding to see some big spikes back up. Thankfully today, I haven't checked in the last 5 minutes, market's a little more calm. VIX is starting to come down, but some of these events kind of help understand why we had some weakness this last weeks. It's not just a one-off event. Market stability or instability tends to build over time, and we saw it kind of pop this last couple of weeks. And with that, you look at just kind of the vol profile of equities. especially over this last week, and draw some comparisons to what we've had in the last 30, 40 years. Very few instances do you see intraday market vol be as high as it has been, or market vol of consecutive days be as high as it has been. So just looking at where do we have days where there's a 7% swing in markets for 2 consecutive days. Handful of results going back to the 90s. Tariff issues this last week, COVID, GFC. For those that were around then, 1997 Asian financial crisis. For those that won't, it's a great Wikipedia search to go down a rabbit hole and really understand the pitfalls of excessive leverage and volatility. But this is an unusual event, and I think it's important for us to say this is unusual. And as we came into the year, we weren't predicting this type of volatility nor anticipating this type of volatility, but we did come into the year really emphasizing diversification. I think it's a really important point. You want to be diversified. You just don't know what's going to happen, especially when you start to lose some clarity on what kind of growth incentives might be flowing through the economy. And I think that message still stays to this day. Look to be diversified. We'll have some other thoughts on other asset classes as well. And I think a point of emphasis also is when you do see these volatility spikes and you see fear at its excess, we really want to be leaning in. We want to be looking at markets where, should we see VIX above 40, which is really the red line for us. As soon as VIX hits 40, we start having conversations. When are we rebalancing? How are we going to do it? Where are we sourcing funds from? And you can see here when VIX is above 40, above 50, the results for, and we're using S&P 500, the results over the following year are quite good. So when you have peak fear, you have peak panic, long-term investors, we're liquidity providers. This is our chance to put money back into the market. And history says you'll be rewarded over time. You might not be rewarded over the following week, following 30 days, or frankly, the following 9 months. It takes time, usually for recovery. Maybe not as quick as we've seen the last few days, but we do believe when you do see these volatility spikes, which we may see more of over the course of the next year, it's a good practice to be looking at rebalance opportunities when that arises. And when we look at some of the volatility we've seen, it hasn't just been limited to equities. You look at treasury yields rising almost 50 basis points at the 10-year point, from last week. A lot of speculation around what's the cause of it. We'll have some discussion about that in a bit, but I think the short answer is these aren't as unusual as you might think. Previous periods where we've seen large deleveraging events, whether it's global financial crisis, COVID times, you do see a blip where treasury rates rise. Also, this last week corresponded with a lot of taxpayers raising funds to pay taxes, which typically is a very seasonal event that occurs. So folks selling treasuries, raising cash to pay taxes, tend to see this every year. This is a kind of a week or few weeks of weakness in the treasury markets. So we think that's likely the kind of most common or likely explanation of what we saw in treasuries. But if we see weakness over the next couple of months, then clearly more questions will have to be asked. And lastly, just briefly before I turn it over to Jen, I want to just hit our market outlook. We've tried our best to push communications out to folks just in terms of how we're thinking about recession risk, rebalancing. So it'd be good just to kind of tick through those briefly. In terms of recession risks, recession risk is much higher clear than it was at the start of the year in terms of both outlook for corporate profits, consumer spending, manufacturing activity. And I think the line that we kind of look to is if effective tariff rates stay above 20%, you're likely looking at a recession. And I think we've seen, especially in the last couple of days, the positive reaction from the markets as exceptions have started to flow in terms of what type of tariffs would be assessed on certain products, what levels of tariffs were likely to kind of flow through, and you start to maybe hope will be below that 20% number. So it gives some support that recession doesn't have to be a guarantee just because of tariffs. And this is going to be a test. We look at the U.S. consumer or the U.S. corporate kind of earnings machine, probably the most resilient in the world certainly going to be put to the test this year, especially when it comes to consumer spending. Secondly, and I think probably goes without saying, but we'll brace for volatility. And as I said, let's try to be diversified. Let's try to maintain kind of adequate levels of safe haven fixed income exposure. Make sure you have sufficient liquidity, because we're likely to see more of these type of events and maybe more uncertainty in regards to tariff policy over the coming months. And I mentioned this, but I'll mention again, really focused on when we do see periods of heightened fear, look for opportunities to rebalance. In this case, S&P 500, maybe it's treasury exposures, which haven't come in as much, treasury yields hasn't come in as much as we would like to see. Chance to kind of build up some of these exposures to be prepared over the next, 12 to 24 months. And I think on top of that, just general advice that, we kind of reaffirm to ourselves when we have discussions and, like to share with our clients is, really just stay the course. Don't pull back from markets. It's hard when panic takes hold, when fear is high, uncertainty is high. It often means these are some of the best opportunities that might come up. So look for opportunities should we see bigger drawdowns. We're liquidity providers. Let's try to find opportunities that come up over time. We don't have to be overly aggressive about it, but at the same time, let's lean into some of the opportunities that might come. So with that, I'm going to pass it to Jen, who's going to walk through some of the tariff discussions.
Thanks, Phil. So we wanted to talk in a little bit more detail about the policy backdrop that we've seen this year, with more of a focus on the tariff side of things. But just kind of starting here to set the background a little bit, I think the slide title here says it quite succinctly, but clearly policy changes are afoot. There have been a very significant amount of executive orders issued by President Trump in his second term thus far, on both an absolute and a relative basis. And the changes have been fairly wide-reaching in nature, with a lot of these executive orders importantly kind of setting the stage for many of the tariff actions that we've seen as of late that we're going to talk about in some more detail. But whether that's declaring national emergencies or authorizing certain trade investigations, those are steps that are required in some circumstances to get the ball rolling for tariffs. And just looking at this, you can see even before the April announcements that we had, this backdrop was clearly signaling that we would have some more meaningful policy changes coming this year, which has fueled a lot of the uncertainty for markets and the economy, since this just brings about a much wider range of outcomes moving forward, which markets have certainly reacted to this year. Now, if we look a little bit more closely at the tariff side of things, I feel a little silly kind of saying this, but it is a highly fluid situation. So this is encompassing all the major items that we know today on April 15th. And I'd say this is highly suspect in terms of changes we could see to the tariff rates themselves, whether we get more exemptions, maybe new tariffs added to this list, and so forth. So, what's interesting is I've continued to kind of point to the fact that we have a lot more details on tariffs versus maybe the start of the year, but maybe not a whole lot more in terms of clarity for the market. So that uncertainty overhang has not gone away despite a lot of these details that we've gotten. So there are still many questions in our mind around where these rates are ultimately going to settle. If we get negotiations or retaliations, what might those look like? And those are some things that will inform ultimately what the end point for tariff or trade policy will be. But you kind of track through this list. You can see starting with the ramp up in March with Mexico and Canada, then expanding to include more targeted tariff increases on aluminum, steel, autos, and so forth. And this all really came to a head in that first week of April with the more sweeping tariff announcements that were met by that bigger market reaction. And I think it's fair to say, why did the market respond so aggressively? The magnitude, the scope, the timeline, all the details on the tariff announcements were much more significant than what was priced in ahead of that day. So, this added to a lot of concerns around disruption of global trade flows and global supply chains, and had markets kind of thinking about what if there is a more meaningful hit to economic growth? And what if we do have a US recession? So a lot of those topics became top of mind. And this was in some ways almost a piecing together of the cascading effect that tariffs can have if they are implemented in full at that April 2nd announced level. Now, the one thing I'd say is we are sitting here close to 2 weeks after the April 2nd announcements. Some of this has been paused, as Phil highlighted. There's been some exemptions as well, which have been favorable for market sentiment in the near term. I do think moving forward that maybe we need to kind of focus on the fact that our base case is that these rates will still be negotiated lower in some way, shape, or form. And in terms of just some of the exemptions, it's highly likely that we're going to be looking at more focused tariffs coming down the pipeline, whether that's for pharmaceuticals or semiconductors, which have been both in focus as of late. So highly likely we'll get more changes here suggesting that we're going to be living in this tariff-driven headline reality for quite some time, as this is kind of the main driver of market sentiment in the near term. So if we kind of flip forward, just want to get into a couple of the details behind this. Typically, we wouldn't get this far into the weeds on different policy implementation options, but I think the details are quite important here. The big delineation I draw between a lot of these different policy options is that there are some that are more focused, oftentimes more sector-specific tariffs that can be enacted for national security purposes or to protect domestic industries, versus on the other side of the spectrum, there are these broader, more sweeping tariffs that can be leveraged following a declaration of a national emergency or other specific economic conditions that might warrant their use. Now, the reason I'm kind of going into this detail is because each of these categories has some different nuances to be aware of. And specifically, when we talk about the focused tariff tools, those require a much longer process in terms of getting them up and running. So there's an investigation process, oftentimes a comment period, sometimes an exemption process too. And that means we could be looking at some time period up to 12 months for them to actually come into effect, versus those broader sweeping tariffs that allow the president to act more unilaterally and to put tariffs in place with just a much quicker turnaround. So what we've seen thus far in Trump's second term has been a mix of both. I think there was maybe more attention on the April 2nd announcements, given the magnitude, as I mentioned, but also given the method by which it was applied using the International Emergency Economic Powers Act. And the last line of this table here, but typically we have not seen this used for tariffs, but more for sanctions or other economic restrictions. So it did give the president the opportunity to put them in place almost instantly, but there could be still a little bit of friction with potential legal challenges given the broader language in that statute that could maybe amplify some of the uncertainty and maybe drag out the timeline a little bit longer than the instant response you would typically expect here. So I give all that background and kind of want to focus on where are things going today in terms of tariff rates. So with the announcements from April 2nd, there were plenty of estimates out there that said the average effective tariff rate would go up to 20, 30%, depending on what products were included. Clearly a very significant shift in posture for U.S. trade policy coming from this. Now, with some of the walkbacks we've seen over the last few days, this number has come down off of the April 2nd high. And if it holds, especially since there are such outsized rates now imposed on China relative to other countries, we could expect that this would have some knock-on effects if everything stays in place as stated with over 100% tariff rate on China. That would start to impact the trade volumes between certain countries that could end up impacting this average effective tariff rate. So this is not a number that's set in stone. We could see trade volumes adjust if things do continue at these elevated trade tariff rates, but just something to be aware of. But regardless of kind of all of these dynamics, I think it's very fair to say that we're going to be looking at significantly higher average effective rates versus last year. So with all of the moving pieces around tariffs that we've described and the associated uncertainty, this does put the Fed in somewhat of a difficult situation ahead of the tariff narrative. When you kind of think about where we were with the economy, we had the start of a Fed easing cycle in response to this trend lower in inflation. And we were still getting some fluctuations in rate expectations based on recent labor market data, but that was really disrupted almost with recent market dynamics where the Fed had to shift their approach and maybe be a little less reactive and employ more of a wait and see policy, which I think we'll talk about a little bit more in a bit. But it really does complicate both sides of the Fed's mandate in terms of thinking about the uncertainty now on the inflation side of things relative to the growing downside economic growth risks. So not really clear-cut dynamics that they're working with. And one complicating thing on top of this is that I think it's fair to say we could expect that tariffs will drive distortions in some of the inflation and activity data as well, especially in the near term, and the Fed's data driven. So quite the conundrum there at the moment. So kind of bringing this all together with all of the dynamics we've talked about today, unsurprisingly, Phil talked about this up front, but performance has been challenged, particularly in April, as investors have really had to take in all this information and adjust their growth expectations and price in potentially more economic weakness down the line. So, clearly a very risk-off tone that was flowing through markets, which has been particularly acute for the US-based assets here. And with that said, we've had a little bit of a rally as of late. It's hard to say that we've hit a bottom in markets. There are plenty of unknowns as we've been highlighting today, but markets have rallied in reaction to the fact that there might be a potential off-ramp with some of the recent announcements versus the trajectory we were on with just a more escalating trade war over time. But regardless, I mentioned that the situation is very fluid. These numbers have been changing a lot by the day. I think it's fair that we will be looking at news flow driving market performance in the near term and likely stuck in some of this cycle of volatility until we get something that kind of sustainably can change investor sentiment. So with all of that said, just wanted to end our prepared comments with this checklist of a few items for consideration in this type of environment. Phil touched on a couple of these, but I think they're very important to reiterate, and kind of first and top of mind for me is that it's important to maintain that long-term perspective and really not get caught up in all of the news flow. Sometimes this is when the hardest decisions are made, but when the most value can be added by not pulling away or selling when there's panic in markets. So staying invested is key, especially since timing daily market moves is extremely difficult to do. And if you miss the best return days, that can be very hurtful to long-term performance. And they oftentimes do come right after some of the worst days in the market as well. And to that end, I know Phil touched a bit on the rebalancing side of things, but just having a disciplined rebalancing policy is in place is key today. And beyond that, there's a couple other pieces in here. I think you frequently hear from us that maintaining appropriate liquidity levels is an important aspect of portfolio construction, but especially so in this environment. We want to ensure that portfolios have adequate, appropriate safe haven exposure and liquidity just in case there are potential cash flow needs that arise that need to be serviced. And in addition to that, we have just kind of be aware of the denominator effect that can take hold within portfolios. During times when we tend to see these larger drawdowns across public markets, private market valuations are going to be slower to adjust. So it will appear to have an overweight to private market targets, and looking to kind of tolerate these levels to the extent that there is flexibility to do so is likely the best approach, and not kind of adjusting to this dynamic. And then finally, we've talked a lot about all the volatility and moving pieces in markets today, but when we tend to see policy changes and this type of intraday or monthly volatility across markets, it does create a new set of winners and losers oftentimes across markets. So that provides somewhat of an interesting background for active management to add value relative to passive. So with that, I'm going to turn it back to Phil.
So, pulled our slides down. I just wanted to have kind of an open discussion on a couple items that we're seeing. And I think the first piece here is just in regards to the Fed. I think a lot of people are asking kind of, where is the Fed? Which I think is a reasonable question. We've somewhat been kind of trained over the last 15, 20 years to have the Fed step in and kind of provide market liquidity at periods of market stress. Talked a little bit about inflation and bank rates, but maybe Jen, you can kick us off. Just some thoughts on kind of where the Fed's mind is at, how they're thinking about things, and just remember to hit unmute before you jump in.
Yeah, thanks. I talked a little bit about how difficult the situation is on both sides of the Fed's mandate. And on the inflation side, I think what's hard is that, especially with the data we got last week for CPI and PPI in the US, there was clearly this trend lower. And all else equal, I think we would have been on a healthy trend back to target. Versus today, you have this wild card of the inflationary impact of tariffs. So regardless, I think of where the rates end up settling, whether it is the peak rates we saw on April 2nd or something lower as we might expect, we will likely see some price pressures come from that. And even if it is something that's more of a near-term phenomenon versus a persistent form of inflation, that's something that the Fed has to take into account, especially given the inflation episode that we just lived through. And I also want to kind of tie this a little bit just to my comments about the different ways that tariffs can be enacted. If we do see more of those broad tariffs coming through, that by nature will have a wider impact on inflation versus those more targeted sectoral tariffs. So a few aspects that I think are feeding into the Fed's uncertainty, and I think it's probably difficult to hear this, as you were saying, given that we're all used to the Fed kind of stepping in, but to the extent that we don't have a recession, then we could see rates kind of staying at this level for some time. And I think that's something that's maybe not being appreciated by markets given the reaction to the negative downside growth risks.
Yeah, and I think it's an interesting aspect of we like to think of the Fed as an apolitical organization. However, they're in Washington, D.C., and there's no escaping politics. And, there is a fair amount of political competitiveness and political tension that does exist from different parts of the administration to the Fed. And I think one of the things to kind of we're aware of is, the Fed should be reacting to data, should be reacting to what they see in the markets today. And if they see a dislocation in treasury markets, they see a dislocation in liquidity, they should be stepping in. But at the same time, kind of signal they don't want to be providing almost a escape valve for tariff policy. And I think that is a bit of the concern that some market participants have, that the Fed's going to be a little too slow. And you mentioned kind of the risk of a recession, Jen. That risk probably is most acute as we start to see job losses. And if we see job losses and the Fed hasn't acted, they're probably too late. The recession's already taken hold. And I think that's also one of the concerns of maybe we need to be a little more proactive in terms of what we're seeing from the Fed, but that's more of what we'd like to see as opposed to what we're likely to see. With that, just wanted to take a quick minute just to touch on treasury markets as well. I think there's been a lot of rumors and a lot of discussion on what's going on in treasury markets. I mentioned that at the opening of my comments. And I think the piece that kind of would emphasize is there's no evidence today there's widespread selling from countries pushing their treasury holdings out of their central bank reserves. China and Japan are the biggest holders of treasuries outside the US. And again, no evidence of that. I think we saw a lot of headlines of speculating on some of some of the movement in treasury rates. I think the other piece to mention is it's not easy to hide. So if we do see activity from whether it's China, whether it's Japan or other countries selling their treasuries in the markets, we'll hear about it relatively quickly, and relatively quickly being very quick. And I think a couple things to look to in terms of where would you see treasuries having a problem. So let's say a month from now, we get another weak CPI print, which we had one this last month. We see job concerns start to rise. We see expectations of Fed cuts start to rise. We should see movement from treasuries. And if we don't, then I think there's some valid questions to start asking. But again, no evidence of that. We firmly believe that treasuries are a safe haven security. And if anything, if yields back up a little bit, it's a great time to kind of load up on treasuries to kind of prepare for any economic weakness. With that, Jen, maybe a couple of questions that we can take that kind of have come in. Can you talk a little bit about credit spreads? What are credit spreads telling us today?
Sure. And it's interesting. We spent quite a bit of time talking about the rate side of things, where we did see some upward pressure in rates and we saw equity markets clearly selling off a lot. Credit had a somewhat more muted response relative to VIX being at 40 and going through some of the other metrics that we highlighted up front. So we have certainly seen some spread widening, particularly in the lowest quality spaces of credit. But I think with all the other conditions that we've had, we probably would have expected a bigger spread widening to occur relative to the stress and the fear that was priced into markets if there were true growth and recession concerns out there. So the bond markets may be flashing a light signal, but not really blaring the alarm on the recession just yet.
And one of the questions that came in, maybe we can kind of address that, both of us. Is there collateral damage from either the tariff policy or future implementation of tariffs that the market hasn't appreciated as of yet? I don't know if you want to take that first.
Yeah, I think even going into some of the April announcements that I've been saying we had kind of the broad idea of tariffs priced in, but all the second order effects maybe hadn't been quite as much appreciated. So I think the idea of prices moving up, growth being a little more challenged in general were there, but now we're talking about if these rates or something similar is in place, what does that mean for decision making for business and consumers? I think that's a really big piece that we're seeing kind of show up in a lot of the soft economic data out there, that there's almost this kind of stalling effect where people maybe want to delay strategic decision makings for capital expenditures or home improvements or whatever the example is out there. And if that's the case, that does weigh on economic activity for the country. So I think that is one bigger concern. And then aside from that, I'd say the earnings profile for a lot of companies might be more challenged. If we're talking about reorganizing supply chains in reaction to these tariffs, that is a costly thing that does not happen overnight. So there might be some margin pressure, for example, coming from that if these are in place for a multi-year time horizon.
Yeah, and I think the timeline of how we process kind of change. The tariff announcement on April 2nd certainly was a surprise. It's akin to kind of a big geopolitical shift. It changes the paradigm, changes kind of the rules by which we think the economy will operate. Markets have to pivot and discount that very quickly. And often it overreacts. And, we saw that. And when you see those overreactions, we want to be rebalancing in, we want to be leaning into markets. I think as we're transitioning through this, I think the market will be less and less surprised should we see various, shifts or announcements on kind of the U.S. tariff policy. And then you start thinking about what are longer term implications in terms of, flows in the U.S., foreign investment in the U.S., longer term sources of capital. How is that impacted? How are margin and long-term return on equity targets impacted for the equity markets? But still, I think it's fair to say, the most competitive and profitable enterprises in the world still exist in the U.S., still exist in corporate U.S. And I think it takes me to our last question, Jen. We've talked a lot about kind of concerns the market's addressed, concerns we've heard from our clients and investors, but maybe just kind of thinking about the other side, thinking about the resilience of the U.S. consumer, the resilience of kind of corporate profitability. Is there an upside, or is there maybe the market's overreacting some of this and the consumer and corporate America maybe are more resilient than we think, despite some of the uncertainty that we've seen with kind of the newly announced tariffs?
Yeah, I think you said this up front, Phil, but this is something that's clearly going to be tested in the coming months. And I talked a little bit about the role that tariffs can play on weighing on consumption decisions. But we are seeing kind of the flip side of that at the moment, where we're hearing stories about people front-running purchases for big items in anticipation of tariffs. So in the event that we do get lower tariff rates, this could be something where all these clearing events happen. Not that that is necessarily our base case, but if a lot of the tariff risk does go away, then we could be sitting at a position where economic activity has increased in the near term, and maybe a lot of the concerns that were priced in were a little overblown. But I think as we look to a lot of historical anecdotes too, U.S. consumers, U.S. businesses have been resilient throughout countless crises, and the pandemic's probably the easiest and most recent example to point to, that there was concern that the economy would come to a grinding halt and earnings would fall off a cliff. And we did see in some ways a temporary impact to that, and then everything kind of resetting back to trend line over time. So I think that's the anticipation, kind of looking out over a little bit longer time horizon here.
And maybe just to kind of round off last few questions. First on fixed income profile and kind of duration of fixed income portfolio, and obviously different for different types of clients. Our long-term corporate clients are going to have a more longer duration focus. Others are going to have more of a safe haven liquidity focus. That said, we are not of the view that we want to be shortening our duration of fixed income portfolios. We're comfortable holding index duration, whether that's the AG or US Treasury index. In some ways, having that full curve exposure, we think, in preceding months, especially if we see some more economic weakness, will be well appreciated. And then also, as we think about kind of the US dollar, the US dollar movements over the last couple of weeks kind of mirrored what we've seen in Treasury yields in terms of not quite responding in the same safe haven profile we'd expect. And I think, again, likely explainable by both, deleveraging we're seeing and some of the carry trades that exist. You did see a little bit of a yen rally, which is fairly typical, and also kind of an expectation that maybe economic growth between US and Europe won't be as big of a differential as it might have been that we would expect at the beginning of the year. And on top of that, dollar was already a little expensive coming into this quarter. So I think there's some things that we can kind of explain. And again, if we're 3 months from now and we're seeing Treasury yields rise, we're seeing continued dollar weakness, then there's some questions we'll have to start to ask and some discussions. But I think that's far from base case and more likely a minority tail risk in our opinion. So again, thank you all for joining. Appreciate the time. This recording will be posted and slides posted on our website. Thank you again, and hopefully everyone has a nice quiet week, which I think we all deserve it after the last few weeks of market fall. So thank you and have a great day.